Welcome back. I'm Mark Duggan, the Trione Director of SIEPR, and I hope you've been enjoying the Policy Forum so far. We're now going to settle back in for our second session on student loan debt, and I'm really thrilled to be introducing Lesley Turner and Kristin Blagg. Lesley is currently an assistant professor at University of Maryland, but will be starting as an associate professor of economics at Vanderbilt University this coming fall. She's a faculty research fellow of the National Bureau of Economic Research and a SIEPR research affiliate. I'm just going to grab this water right here. So I'm sorry, everyone. Just bear with me. I didn't. And prior to Vanderbilt, as I said, Lesley taught at University of Maryland. Her research looks at the role that government should play in providing and financing higher education. Lesley's recent projects examine how incentives built into the structure of higher ed financing affect students and colleges and the implications that these responses have for students' educational outcomes, loan debt, and labor market outcomes. Her work on K-12 education policy has examined school accountability measures, incentive pay for teachers, and how school and classroom gender composition impacts student achievement. She graduated from a joint bachelor's and master's program at the University of Michigan in 2005 and received her PhD in economics from Columbia in 2012 and was awarded the SIEPR Distinguished Young Affiliate Prize in 2015. I remember we met when you were a PhD student. Do you remember that? When I visited Columbia anyway, so it's great to see you back here at Stanford. It's also my pleasure to welcome Kristin Blagg. Kristin is a research associate in the Center on Education Data and Policy at the Urban Institute. Her research focuses on K-12 and post-secondary education. She's conducted studies on student transportation and school choice, student loans, and the role of information in higher education. She spent 4 years as a math teacher in New Orleans and then New York City. And in addition to her work at the Urban Institute, she is pursuing a PhD in public policy and public administration at the George Washington University. She holds a bachelor's degree in government from Harvard University, a master's in education from Hunter College, and a master's in public policy from Georgetown University. Please join me in welcoming Lesley and Kristin to SIEPR, and Lesley's going to start off at the podium to kick off the panel.
Great. Thanks so much, Mark. I'm really happy to be here and share my thoughts and research on student loans. Whoops. Okay, so I wanted to start off my part of the session with this big picture question. We hear a lot about the student debt crisis, and I think the title of this panel was something along these lines, very provocative title about drowning in student loan debt. And certainly if you ask Professor Google, is there a student loan crisis, the answer is an unambiguous yes. So just a pull of articles that come up when you Google student loans. Student loan debt statistics in 2019, a $1.5 trillion crisis. Student debt has kept home ownership out of reach for 400,000 young families. The student debt crisis is about to get worse, and the looming student loan default crisis is worse than we thought. Okay, so there is a lot of rhetoric out there about this student loan crisis. And I'm going to start off by just presenting some facts. So what has been going on with student loans? Who are borrowers? How much are they borrowing? And is this something that we should be as concerned as Google thinks we should be about it? Okay. So student loans are one part of household balance sheets. This is a graph showing the total composition of US household debt over time. And you can see that this light blue bars, the vast majority of household debt is still in the form of mortgages, is still in the housing market. But student loans are a growing part of households' balance sheets. Housing debt peaked right during the Great Recession and has just now recovered. It's almost back at its 2008 peak, but student loan debt over the same time period has more than doubled. So at the peak of the Great Recession, student loans were about $0.6 trillion, $600 million. And if we look today, again, there's this $1.5 trillion number. Student loans are now the largest source of unsecured consumer credit, and they're the only source of household debt that grew during the Great Recession. Okay, so this is Still small relative to housing debt, but it's growing in importance for households, and it seems to be behaving differently than other types of debt. Okay? So one question that comes up is, why has student debt increased? What's going on here? And the answer is pretty straightforward. First, more students are borrowing. So this chart is showing the share of undergraduate and graduate students that take out student loans in a given year. And if we look from the 1999 academic year to the most recent data available, there's been about a 10 percentage point increase in borrowing among undergraduates from 29% to 39%, and an even larger increase in borrowing among graduate students. So more students are taking on student loans. At the same time, the amount that borrowers are taking on is larger. Okay, so both of these things mean that there's more debt going out there into the world. The final reason why we've seen this pretty big increase in student loans is something that is less talked about, and that's the outstanding debt that has been taken out is being repaid at a slower rate. Okay, so this figure is showing among three sort of sets of borrowers that entered repayment sort of right before or during the Great Recession, right after, and then in 2010 through 2012, what percentage of these borrowers have kept up with their interest and paid down just $1 of principal? Okay, so just to give you some context, if you are on a 10-year repayment plan, at this point, 3 years after starting repayment, you should have paid down somewhere around 15%. Okay, so paying down $1 of student loans seems like it should be not that hard. But if we look in this most recent cohort, less than half of all student borrowers had made any progress in paying down their principal. And for many of these borrowers, their balance is actually increasing. Not only are they not paying down their principal, but they're not keeping up with the interest. Okay, and this non-payment of student loans has been increasing over time. So all three of these facts, the rising take-up of student loans, the amount that students are borrowing, and the fact that once these borrowers get out there into the world, they're not paying down their loans as quickly as they should be, has led to this big growth in student debt. Okay? But is this a crisis? Are students borrowing too much? There's been a lot of efforts predicated on the assumption that this is a crisis, that it would be better if we could get students to borrow less. Okay, this has taken the form of anywhere from providing information and additional loan counseling to students, schools engaging in comprehensive debt reduction initiatives, schools that have decided they are not going to offer federal student loans anymore. They're allowed to do this. In fact, a number of California community colleges have decided we're not going to let our students borrow through federal loan programs to protect them from taking on this debt. And then there's a practice that schools are increasingly engaging in, which is basically recommending students not take up loans or not offering student loans when students get information about their various options to pay for college, okay? And this actually isn't preventing students from borrowing, but it potentially is sending the signal that it's really not a good idea for you to take on student loans, okay? And one thing to keep in mind, we are all sitting here at Stanford, I'm going to be joining Vanderbilt, coming from University of Maryland, is that our experiences are probably not representative of the experiences of college students out there in the world. If you were to just grab a student off the street, they're not going to be going to a place like University of Maryland or Stanford. They're going to be at an open access four-year public institution or a community college, okay? And so while places like Stanford offer generous financial aid, even if they did not, it probably would be a pretty good idea to borrow to get a bachelor's degree from Stanford, okay? That would probably pay off, and then some. But for a student who is going to a community college, okay, this is an important question. Should this student be taking on a loan? Is this going to pay off for them? Okay, so for the last part of my time here, I'm going to talk about some research that I've done to try and answer this question, focusing on this policy of recommending students to not take on loans, or quote unquote offering loans that are less than that student could borrow. Okay, so in this project, my co-author Ben Marks and I worked with a community college, and we ran an experiment, okay, where students were randomly assigned to either be offered loans or to not be offered loans. Everybody could borrow, so this wasn't a true offer. You could just think of this as a recommendation. But this recommendation had a lot of bite. Okay? Students who were offered a loan, they were about 40% more likely to borrow. Okay? And they took up about a $4,000 loan on average. So what happened to these students? These students who borrowed because they got this recommendation from the college, they attempted more credits, they earned more credits, they got higher GPAs, and they were more likely to transfer to a bachelor's degree program. Okay, and these effects were pretty sizable. They were as large as effects of the most effective interventions at community colleges to date. Okay, so for these students at this community college, it seems like there were pretty big benefits to borrowing. Okay, they were able to take more classes. They were able to do better in the classes that they took, and they were able to continue to progress towards a valuable degree or credential. Okay, and we know that among those who go to college, the largest benefits accrue to those who leave with some sort of degree or credential. So when we come to this question, are students borrowing too much? Should public policy or should universities be working to get students to borrow less? We have to weigh the benefits of borrowing less, that these students won't be leaving with debt, that potentially makes it harder for them to buy a house or buy a car. But at the same time, how will they be paying for college if they don't take on this student loan? In the current system of financial aid, these loans won't be replaced with grants. These students will be using some other source of financing to pay for college. Okay, they may be using a credit card, they may be working more. And an interesting fact is that if you look at the borrowers who have left college and are struggling to pay their loans, the ones that struggle the most are not those with the highest debt. Okay, low balance borrowers are actually those who are most likely to default on their loans. And this is because low balance borrowers are those who don't complete college. They're those who go to college for a year and drop out. Okay, and so in this conversation about the student debt crisis, there needs to be a weighing of what are student loans doing. Okay, they're helping individuals pay for college, and if this helps them get to a degree or credential that will pay off in the labor market, well, maybe this is a trade-off that's worth making. And in the current financial aid system of grants and loans, it seems like the average low-income student benefits from borrowing. Okay, so this is something that I hope we will explore more in the question and answer, and I'll now turn it over to my colleague, Kristin.
Thank you, Lesley, and thank you guys all for having me here. Lesley talked a lot about who takes out loans and the impact that taking out a loan can have on a community college student's success. And I'm going to talk a little bit more about repayment and where we see some of the gaps in repayment or places where we could make student loan repayment easier. So I just want to reiterate the point that Lesley made that most student loan balances are comparatively small. So you'll see just on this histogram, these are individuals who entered repayment between August 2011 and August 2012. And you'll see most of those loan balances are sort of squished on the end below $20,000. This sort of high column at the end are folks that have more than $100,000 worth of debt. And if you can imagine that line looks very much like those things, but it kind of stretches out to the exit sign over there, right? And so frequently those are the borrowers. We hear about the folks that have 6 figures worth of debt. Those folks often are individuals who went to grad school, or they may be parents that borrowed for their child's education using Parent Plus loans. But regardless of the fact that we we sort of know these low balance borrowers are more likely to have repayment issues, more likely to default. I think one of the things that is kind of overlooked is how sort of variable the experience of repaying these loans can be for individuals. So that's this is the same cohort of students that entered repayment in 2011, 2012. And this is just what happens to their debt over time. So in 2012, most of them are current because they just started repaying their loans. A few people are going into early delinquency, which is 90 days or less late on their payments. Some are going into late delinquency, which is more than 3 months delinquent. And just a very small percent of this cohort are defaulting. It's very hard to default in that first year. It takes about 360 days. 2 years out, when we're looking at kind of what their progress was in those 2 years, you see folks who were delinquent are becoming current again. Some of those folks that were current are becoming delinquent. And we do have some folks that are defaulting in that time. And then finally, in 2016, you see, again, some folks recovering. In this graph, if they default, for simplicity, I keep them in default, but some folks do come out of that default in 2014 and move back up into a current status and try the repayment cycle all over again. So when we're talking about borrowers, we're talking about folks that are flowing in and out between delinquency and default and possibly trying different repayment options. When we are looking at folks that are defaulting, we're looking at folks that are pretty financially distressed. So this is the same cohort of borrowers, and just looking at anyone who defaulted 4 years after entering repayment. These folks are much more likely to have, in the year before entering their student loan repayment, to have utilities or medical debt collection, or other types of collection, including having like retail cards or bank collections, and are much less likely to have some of the types of consumer debt we might think about as positive, such as being able to hold a credit card, having auto debt or mortgage debt. So we're looking at folks that not only are potentially making lower incomes, but also are sort of starting from a lower point than just a zero balance sheet. So I mentioned that borrowers have a whole lot of options for repayment and that they may be cycling through these different systems. Well, what are those options? If you have a federal student loan, you could do the standard repayment plan. That is sort of the default option, 10 years, standard payment over those 10 years, 120 payments, and you're done. But you could also do a graduated repayment plan where your payments are lower at the start, higher at the end. You could also do an extended repayment plan where you're moving from those 10 years to a longer period. That could be fixed or graduated. Then we start to get interesting. You've got 5 different income-based repayment plans. These are plans where your income is going to be exempted, typically at 150% of the poverty level. And then you're going to pay a share of your income above that level, typically in these more recent plans, which are the pay-as-you-earn and revised pay-as-you-earn, typically about 10% of your income above that poverty threshold for 20 years or 25 years if you have graduate student debt. In addition to those programs, you have public service loan forgiveness, which works in concert with the income-based repayment plans, as well as a host of other options, including deferment of those loans, forbearance, teacher forgiveness, and various cancellation and discharge programs. There are lots of different ways that folks could work their way through this repayment system. So what I'm going to do is focus quickly on the income-based repayment because, as you can see, 5 different plans. A lot of what you're eligible for depends on the type of loan you have and when you took them out. So we don't have a lot of information. We're getting more information from Department Ed all the time about who's using these plans. But if we look at the Survey of Consumer Finances, which looks at households and the types of debt they carry, we can get a little bit of a look at how people who have federal student loans are repaying their debt. And so the blue bar are folks that are reporting using income-driven repayment, some sort of income-driven repayment. The yellow bar is somebody who says, well, I'm on a different plan. And the gray bar are folks that say, well, I'm actually not making payment on that loan right now. And as you can see, the folks that have sort of lower household wage data or salary data are actually much more likely to report that they're not making any payments at all, despite the fact that they probably would be eligible for a $0 payment under an income-based repayment system. And that would go towards credit towards their payments under that program. So the income-based repayment program is really hard to access, really difficult to understand. You have to recertify every year. And we know that there are folks who probably just aren't taking this up as an option. One of the other big things we talk about student debt, are the racial and ethnic differences in default and repayment. This is work that has been put forward. Ben Miller at CAP has looked at differences in repayment rates, and this is work from Judah Scott Clayton, writing for Brookings, looking at gaps in repayment for folks who entered school in 2004. So when we look at the unadjusted gap, the way to read this is that, and I apologize, I've covered up. So the dark blue bar is the gap between white borrowers and black borrowers in terms of their default rates. So to read this graph, black borrowers are 25 percentage points higher in terms of their default rates compared to white non-Hispanic borrowers. And that's unadjusted, so that's sort of everything in there. If we start to control for different characteristics such as family background, we reduce that a little bit, but that's not the whole story. We can control for the amounts they borrow, but that really doesn't change things that much. Remember, we are looking at those lower balances being more likely to default, so we're not going to get too much off of looking at the amount that they owe. Looking at where they attend reduces that gap a little bit, but we still see a substantial gap between repayment. And then even looking at things like income or job status still indicates some persistence of gaps in repayment or default rates among different groups. And this is a problem, probably a conglomeration of a lot of things, including family wealth, but something that we as researchers and policymakers are concerned about, because this is something that disproportionately affects borrowers of different races. So there are a lot of different policy proposals out there in the world, including debt forgiveness proposals. One of the things that's really challenging about doing broad student debt forgiveness is that folks that have those largest debts are often folks that completed school or went to grad school. So my colleague Matt Chingos and I modeled what the average payments would be by different income quintiles under the Elizabeth Warren's student debt proposal. As you can see, as you get into the fourth quintile, those average debt rates actually become higher. So folks in the fourth quintile would see the highest average benefit from this proposal. The Warren plan fades out at very high income levels, so you do see a little bit of a gap. But again, this is a proposal that, while it would come from a tax of the very wealthy, would generally go to folks that have higher income levels than lower ones. So there are many ways that we can think about improving these issues of student loan repayment. So policymakers right now are thinking about reauthorizing the Higher Education Act, which will help us understand and potentially solve some of these problems. Some of the big questions folks might be thinking about include how should enrollment in income-driven repayment plans, should it be made automatic? Should it be something that's like a payroll tax deduction, which is something that the student loan systems in the UK and Australia do? We could also think more about how the process of student loan default could be improved to get borrowers back on track quickly. We should also think more about whether institutions themselves might be held accountable for the loan repayment outcomes of their students. If you're producing graduates or folks from your institution that cannot get a job, cannot repay that debt, should you have some skin in the game? And to what extent should any, if any, should borrowing levels be restricted? They're already somewhat restricted for folks that are undergraduates, but graduate students and parent borrowers can borrow up to the cost of attendance, which can be why you get those large six-figure numbers. So that's that, and I look forward to the discussion.
Thanks so much to both of you. And I'm only going to ask a few questions. And so I know a lot of students in the audience. So if I look out for questions and I don't see one, I'm going to cold call on someone. So in any case, so I'm curious. We just had a session on the federal debt, on taxes, on spending. And so I'm wondering if there are, if you both think there are proposals in this space that have like really strong bipartisan support. So when you think about tax reform, like whether the rate should go up, whether the capital gains rate should go up, that's a controversial issue. How much, if at all, rates should go up on high income, controversial. But things like broadening the base tend to be less controversial, closing loopholes and that kind of thing. So I'm wondering, in this space, what do you see as some of the more, some of the opportunities for, if there can be bipartisanship at present, where would those opportunities lie in this space? I don't know which one of you wants to start.
So I think there's a lot of agreement across the political spectrum that simplifying many aspects of the federal student aid system could be a benefit to students without increasing spending, without any cost. It's low-hanging fruit. There's been a lot written about the way that students apply for federal student aid. If any of you have done this through the FAFSA, it's a pretty long form. It's a process that involves gathering a whole lot of information. And a lot of this information really isn't very meaningful in determining what kinds of aid a student is eligible for. Kristin talked about the many different loan repayment plans and sort of how students could potentially be benefiting from one of these plans that bases payments on income, but they may not be taking up this type of plan. And so I think in that same sense, there's agreement that simplifying loan repayment options, maybe automatically placing borrowers into one of these income-driven repayment options, which essentially protects them against defaulting on their loans, because if they lose their job or have a cut in their hours, their payments that they're required to make will fall as their income falls, theoretically. And so it will prevent them from having to make payments that are really unaffordable given their income.
Yeah, I think the simplification issue is the biggest bipartisan. We've got this convoluted system that has just been built upon without considering how all these other, how the programs that we layer on top of them interact with other loans that are out there. And part of that is you've got borrowers who've all signed a promissory note and they've sort of agreed to a set of terms and protections that we want to make sure are sort of retained even as they continue in the system. But simplification definitely seems to be the biggest.
Great, okay. And so one change in recent years, I think it's pretty recent, are these income-based repayment programs. I don't think they were around 10, 15 years ago, but or were they even around then? Yeah.
One of them has been around for the last 10, 15 years, but it's
otherwise than
yes, the ones that are widely used are pretty new.
And they've grown more generous over time.
So like as an economist, one thing that I worry about, and I'm just curious to hear your thoughts on, are incentive effects of these things. So to what extent, if you have income-based repayment, does the 26-year-old decide, yeah, playing video games at home in my parents' basement for the next 10 years sounds good because then I won't have to repay my student loans. So is that something that should be, I mean, that's an extreme example, but something to be worried about influencing people's decisions about whether to work, where to work, how much to work? Yeah.
And I'll even add on to that, I decide to study underwater basket weaving in college rather than engineering because I want to have more time to enjoy myself, and I know that if I can't get a job, these loans I've taken out will not be a burden on me.
Right.
So are there does the existence of these income-driven repayment plans potentially distort behavior in college and after college?
Right.
I think, this is a question of design, and the way that these programs are currently designed, you would have to be a pretty unique person to take advantage of the structure of these programs. If you are not working, it'll be 20 years before your debt is forgiven. So, year to year, if you work a little bit less, your payments go down, but that debt doesn't go away. And in some cases, the interest will continue to accrue. You may have interest capitalization where that interest gets added back to the principal. And so you would have to be someone who has a really high distaste for working and probably a lot of wealth to really take advantage of the forgiveness aspects of these plans.
The one place, though, where this may be a potential issue is in the graduate student lending. So we know that folks that are going to law school or med school may take on six-figure debt, but one of the reasons we allow them to do that is because we know that those are very high-paying careers. However, grad school debt is also master's programs, and the debt limits are still up to cost of attendance, which could be whatever a school sets it at. One of the things that we worry about is income-based repayment combined with public service loan forgiveness, which allows you to do that income-driven repayment plan, but instead of for 20 or 25 years, for 10 years. And so we encourage folks to go into public service. I think that having ways to lessen the debt burden for folks that are in public service careers, whether in the government or in the nonprofit space, is really important. But this may have the potential to distort how willing folks are to take out loans for graduate school.
Great. Okay. And then one thing that Lesley, you referred to was rises in tuition. I'm wondering to what extent you think, my understanding is that higher ed at the state level and local level, the funding for higher ed has been shrinking, certainly as a share of state budgets, and whether and to what extent that has been an important contributor to the rise in the fraction of students taking out loans and the amount that they're taking out. Basically, if you look, I think now at the share of revenues at like the UCs, at the Cal States, I bet at the University of Maryland, that comes from the state as opposed to from tuition, it's a lot lower now than it used to be. So is that an important driver?
So my undergraduate alma mater, University of Michigan, is essentially now a private institution. It gets, I think, less than 10% of its revenue from the state of Michigan.
Right.
So, there's as much talk about rising prices in higher ed as there is the talk about the student loan crisis. And one of the major reasons we've seen big increases in the listed price of tuition in the public sector is declining support from state governments. Higher ed is often referred to as the balance wheel of state budgets. So there are entitlements that states have to pay, Medicaid, pensions, and in most cases, higher ed is not sort of a required place that funding needs to go. And so if there is an unexpected revenue shortfall and the state has a balanced budget requirement, that funding will need to come from somewhere, and oftentimes it is higher education. And so at least in the public sector, when we see increases in tuition, a large reason for that, many believe, is declining state support.
Right.
Yeah, I mean, I think one of the things, and Lesley, you alluded to a little bit, was that is the difference between what we call the sort of the sticker price or the published price and the net price that students pay. Net price has gone, we see that sticker price go up and up and up, but net price has, that the students actually experience or pay themselves, has increased at a slower rate.
Right. So I'm curious whether either of you think there have been important ways in which the private sector is helping students to address this, for like students who have graduated or maybe haven't graduated. Are there any innovations or especially interesting things that are happening in the private sector to, I don't know, cushion the effects of this or not. Maybe that they're making things worse in some cases. I'm not sure.
So a really interesting innovation, which is actually an old idea, is what is called an income share agreement. It's not a student loan, but it acts sort of like a student loan. And how it works is a student signs a contract that says, I'll get $10,000, and in exchange, I will pay 2% of my income over the next 8 years. Purdue University was the first sort of mainstream institution of higher education to start an income share agreement program. They only offered this product to students who had maxed out their federal student loan. So these were students who were pretty far along in their program, juniors or seniors, and they were looking at either going to the private student loan market to finance the rest of their education or to use this alternative product. And take-up has been pretty high, and I think all of us researchers are watching very closely to see what happens, because the incentive effects that Mark mentioned with income-based repayment, we think would probably be even more important here.
Right.
Mm-hmm. Yeah, the other place where the income share agreements can potentially be really useful are in programs that provide work training, such as coding boot camps, but that don't participate in the federal student aid system. So there are lots of hoops to jump through to become what's called Title IV eligible, which means you can provide Pell Grants and student loans. If you have a small coding boot camp and you don't want to jump through those hoops, you can design your own income share agreement such that students are paying back their tuition, but they're paying it back based on the income that they get after graduating.
Great. Okay. And so you mentioned the $1.5 trillion number, and most of that debt, I think, is owed to the federal government, but not all of it. But maybe a little bit is owed to other entities. And I'm curious. So that's an asset. We heard a lot about government debt earlier. So that's an asset that the federal government has. I'm curious if you have a sense of like what the rate of return on that is for the federal government, and do people pay it back? And is that, like, of that $1.5 trillion, do we expect the vast majority of it to be paid back, or what? So I don't know.
Yeah, this is the $1.5 trillion question. So if you ask the Congressional Budget Office, which is the sort of scorekeeper for the federal government, they estimate that about 90% of federal student loans will be repaid. And that's because the federal government has a lot of ways to get their money. Unlike most other types of consumer debt, student loan debt is not automatically discharged with bankruptcy. It's, in fact, very hard to discharge student loan debt. The federal government can take your income tax refund. It can garnish your paycheck, even if your employer is private. It can take your Social Security benefits. So this is a type of debt where there's a lot of ways for the lender to get their money back. At the same time, with the sort of increase in development of these income-driven repayment programs that have forgiveness after a certain amount of time, there is scope for repayment of student loans to look a lot different going forward, depending on participation in these programs and how forgiveness actually plays out. And this is, a question that we won't know the answer for another 8 or so years when it comes to the income-driven repayment plans. The Public Service Loan Forgiveness program, which forgives debt after 10 years of payment for people who are in a public sector job, the first set of cohorts of borrowers who would potentially be eligible for forgiveness under Public Service Loan Forgiveness recently came of age, and most of them, due to various technical reasons and other reasons, actually haven't seen their debt forgiven. I think it's something like 1% of borrowers who applied for forgiveness through Public Service Loan Forgiveness actually have seen their debt forgiven. So I think it's really hard to say.
It's a controversial thing, though, right? That they're
Yes.
too strict with the definition.
Yes.
Mm-hmm.
Yes.
Yeah, it's a lot of hoops to jump through, and I think agreeing with Lesley, one of the really complicated things is that we don't have a lot of ways of predicting what will happen. You know, we'd like to make these programs easier to access because we know there are folks who are eligible that probably aren't taking them up. But you know, smoothing that path means that we are adding more borrowers to a pool that we don't really know what those income trajectories are going to look like.
Great. Okay, so I'm going to ask one more question and then open it up. And so I think the statistic that I have found the most surprising that I've come across in the last 5 or 10 years is the following. If you look at students who start a 4-year college or university, let's say September 1-ish in 2009, and ask 6 years later what share of them have finished 4-year college or university, it is 57%. So 3 out of 7 people who start a 4-year college or university aren't done. And some of them may later finish, but what is your sense of the sort of, we talked a bit about default rates, the 57%, I'm guessing 57%, their default rates are relative, much lower than the 43%. I don't know if people have tried to track that. Yeah.
Yeah, I mean, we know that completion is one of the biggest indicators of whether you're going to be able to repay that debt and not default. I think one of the sort of underwritten stories about student loan debt is, you know, as Lesley talked about, we're not talking about folks that go to Stanford, and not just because you don't really have that much debt as undergrads, but also we're talking about folks that may be older, sort of a non-traditional age, 24 or older. We're talking about folks that are trying to go to school while raising a family, who may be single mothers. So, you know, or who may be going to school intermittently, so part-time or stopping out for a little bit and then coming back or trying at a different institution. And, you know, to the extent that we don't have, you know, we talked about just the repayment system being difficult to navigate, but navigating it with loans from different institutions, you can imagine could even be potentially more difficult.
Right.
I agree completely that the completion crisis is possibly more of a crisis than the student debt crisis, and it's gotten some attention. Just very recently, the New York Times has written about work that Urban Institute has done on gaps in college completion rates, so looking at institutions that serve very similar students. Some do a much better job at getting their students through the finish line with that degree. And as I mentioned very briefly in my remarks, there is evidence that if you go to college and don't get a degree, you still earn more than if you hadn't gone to college at all. But the vast majority of the earnings and labor market benefits of going to college accrue to those who actually make it across that finish line and get the college degree. And so, you know, I think while no one likes to hold debt, and if you ask anyone off the street, would you be better off if I paid off your student loan debt? Okay, that's not really the question that we should be asking. The question should be, you know, does that student loan debt get you to a place you wouldn't be otherwise? You know, without that student loan debt, would you have a college degree, or would you not have completed college? And I think we're just beginning to get evidence as to the answer to that question.
Great. Okay, so with that, with my voice almost completely shot, I'm going to open it up for questions. So let's see. I'll start looking around. Okay, back here in the back.
Thank you both for being here. I'm just interested in the idea of restrictions on how much money one can, like, say they're going to pay back on a loan, because it seems like a double-edged sword. Because on the one hand, the purpose of student loans is so, at least the way that I see it, so that people can, you know, obtain the funds that they see necessary for their experience and eventually pay them back. But on the other hand, we're talking about this whole problem where that's just not the case. So I'm just curious as to what that kind of debate looks like right now in both of your visions.
So the question is whether there should be policies that put a cap on how much students should borrow. So there are caps on the amount of federal loan debt undergraduate students can take on, but there's not caps on the amount that graduate student borrowers can take on. And there's a reason for, I think there's a very strong economic rationale for government provision of student loans to undergraduate students. Many of these individuals don't have any credit history. They would not be able to go to the private market, get a loan at all, or get a loan at a reasonable interest rate. But many of these individuals will benefit a lot from going to college. They'll be able to repay their loan and then some and contribute to the economy. And so government stepping in and providing loans benefits the students, potentially benefits the economy. I think this argument is less strong when it comes to graduate school. There are private loans available for graduate student borrowers. The amount available, the interest rate is going to depend on the program of study, the institution, but in some ways we maybe want a little bit more of these market forces to dictate how much graduate programs can charge and how much debt students should be able to take on for a particular degree. I think where this breaks down a little bit is for programs that provide a large social value, so education, social work, but have pretty low or relatively low private sector pay. And in these cases, there is still a benefit of public funding for loans.
Mhm. And one of the things that on the undergraduate side, so we mentioned, really you can't take out more than about $30,000 worth of student loans over the course of your enrollment in school if you're a dependent student. But that can sometimes lead to lending in other ways. So we do see that some colleges go to Parent Plus loans, which are loans that parents take out for their student. The economic rationale for those is a bit harder. We're giving loans to undergraduates because we know that you're going to go get an education and potentially increase your human capital and your ability to earn. That rationale isn't really in place for parents as much. The intent of the Parent Plus loan program was to help folks initially who have sort of a lot of assets, but that may be locked up in in a house or something, sort of pay their contribution to their child's education over time. But we have seen the Parent Plus program go to folks. Loans go to parents who may have a zero expected family contribution. So parents being saddled with debt as well is another issue that may be a consequence of the capping of undergraduate debt.
Great. Okay, I think right over here we had Rachel, and then behind. Right. Oh, and then okay, and then her. Yeah, yeah. That's okay.
To what extent has there been any research done on the sociology aspect of how kids choose to take on debt and go to colleges? How much, I mean, there's a lot of ego in a high school that gets to put out statistics on where the kids are going to college and the big buy-in to where they're going after high school, and the parents' egos as to where their kids going to college, that may be creating a great deal of social pressure to go on to schools that are expensive, that require borrowing, when they might be better off with a junior college for 2 years in a transfer program to a less expensive school that may educate them just as well for career and have a similar income result without having to take on all that debt to stroke the egos of the schools and the peer group and the parents that really have very little to do with a kid's actual ability to succeed in life. Any sociology work been done on that?
So, I should go back to a point I made earlier that most students aren't going to expensive elite private institutions. Most students are going to their local community college or their local open access four-year public institution. And even if these institutions look much lower cost on paper than your Stanfords and Harvards of the world, they actually may be more expensive because of the fact that these schools don't have a lot of institutional aid to help cover the cost of attendance. And students are allowed to borrow not just for tuition and fees and books, but also for living expenses. So, if you're living on campus, a dorm and a meal plan, but if you're not living on campus, there's a certain amount of money that is, assumed that the student will need to pay for rent, to pay for transportation. And for for many students who are going to these sort of relatively low-cost open access institutions, they're borrowing more to pay for these living expenses than they are for tuition and fees.
Mhm. I think one of the pieces of research that I really find fascinating and important, New America did some great work looking at financial aid award letters, and just looking at the way that grants are presented relative to the way that it can also there's no standard format for financial aid letters that colleges are giving to students, and it can often look like, you know, a line that looks like a grant award might actually be a loan. So I think there's a lot of good work that can be done in clarifying what a student is signing up for when they are deciding between two institutions and two different financial aid packages. So that's one of the areas where I think uh, could could see some improvement.
Great. And then right here. Right here. Julia, right in front of you. Just keep walking straight. Yeah. Yeah.
Thank you both for sharing your insights here tonight. So we sometimes hear stories about people who go to for-profit universities and the for-profit foundation goes bankrupt and they're left with thousands of dollars in debt and with no degree. And how big of a problem is that in terms of the bigger picture? And what policy proposals have there been, or do you think there should be in terms of for-profit universities?
Yeah, so the Obama administration, the Department of Education, tried to sort of do a bit more regulation of for-profit programs and programs in some public and nonprofit institutions by implementing a program looking at gainful employment, so looking at debt to earnings ratios. Those regulations never fully went into place, but the premise of them was that if a program produced graduates that had too much debt relative to their earnings, that they would be sort of cut off from aid. One of the other things that's important to know is that that students that were enrolled in a program that closed do potentially have some options to get their debt discharged. There's like everything in the student aid system, there are hoops to jump through, but that's another potential avenue.
So there's a lot of pretty recent research evidence that suggests the average for-profit student doesn't see any earnings gain from going to college, even if they complete their credential. That's not to say every for-profit institution is not benefiting students, but the average institution doesn't appear to be providing a credential that has sort of value in the labor market. At the same time, these institutions, for programs that are similar to those offered in public four-year or public two-year institutions, they charge a much higher rate of tuition. So students who go to for-profits take on much more debt than their counterparts who are in similar programs in public institutions. If you look at sort of trends in student borrowing, so just how many students are borrowing each year, how much they're borrowing, there was a big run-up in student loans borrowers, student loan debt following the Great Recession. And a lot of this was from more people going to college because the economy was bad, but a pretty large increase in the share of college students who are at for-profit institutions. And we've seen a lot of big closures of for-profit chains, Corinthian colleges, ITT Tech. And so I think going forward, there will be fewer instances of these students who went to a school that closed down just because these schools seem to be leaving the market. But I think that is a very astute point.
Okay, another question right here. Two right there. Okay, 2 minutes. So 2 questions right there. I'm sorry. Next week.
Thank you, Dr. Blagg and Dr. Turner. Quick question then for me is about domino effects. Specifically, we talk a lot about the debt itself, and I know some discussions are starting to start about delaying marriage, about delaying mortgage, car, a lot of things that you think of as hallmarks going forward into adulthood. Has there been any research or longer term research on this? And if so, what do those say, especially for the average person that you've been bringing up?
It's a really great question. So there's been a lot of ink spilled about this question of whether student loans are causing young adults to be less likely to buy houses, that sort of home ownership rates among people in their 20s, early 30s have decreased a lot as student loan debt has increased. It's a really hard question to answer because a lot of things were going on at the same time. So as student loan debt sort of doubled, we also had the collapse of the housing market with the Great Recession, tightening of credit standards. There was, as was mentioned earlier, in 2007, sort of taking out a 15-year adjustable rate mortgage to buy a house with 0% down was seen as a pretty good investment because that house's value would continue to increase. But people who were coming of age after the Great Recession saw lots and lots of people they knew, families they knew, going underwater because they had taken out mortgages for houses that were no longer worth the value of the mortgage. And so, I think it's quite possible that having a student loan on your balance sheet would make it harder for you to get a mortgage because your debt to income ratio is going to be higher. At the same time, we have to think about, for that individual, would they have the job that they currently have if they hadn't taken out that student loan? Would they have that college degree? And so I think it's not just would young adults be more likely to buy houses if we erased all their student loan debt. I think the answer would be yes. The question is, if these young adults didn't have student loans and sort of everything else that came with that, maybe not going to college or maybe not graduating college, would they be less likely to own houses? And I think that's a much harder question to answer.
Yes. Right. So folks have talked a lot about the forgiveness of the Morehouse debt, which is great, and everyone's pointing out, we're all a great natural experiment, but it is sort of an artificial experiment because we don't know, to Leslie's point, if they hadn't had access to that capital to begin with to get their Morehouse education, what their sort of counterfactual would be. I think, one of the big questions that I think is somewhat unanswered and maybe more towards the sociology point is the effect of the sort of psychological effect of having this debt and the effect that this debt could have on thoughts around, taking on more debt for a mortgage or an auto payment or things like that.
So I usually would let one more question in, but I realized that there are ice cream sandwiches and I don't want them to melt. So I think unfortunately but you can come up and ask your question after. But please join me in thanking Lesley and Kristin.